Have you ever noticed that sometimes the stock market seems extremely calm, as if everything is moving steadily forward without any waves? But what you might not expect is that in the next second, it can experience huge fluctuations. We're instantly changing the entire market rhythm and catching many investors off guard. Many people only focus on the rise and fall of indices. When they see an increase of only 0.2% or 0.3%, they think the market is stable and there's no risk at all. However, this superficial stability can make people lower their guard because real risks are often hidden behind the scenes and no one can see through them at a glance. The stock market is like a river. What you see is a calm surface, but there are undercurrents surging at the bottom. Once encountering external forces or unexpected events, it may instantly set off huge waves. Recently, the U.S. stock market is such an example. The index fluctuations are small, seemingly calm, but if you look deeply into trading volume, sector rotation, and capital flows, you'll find that the internal structure of the market has actually been quietly changing. For example, the Nasdaq rose 0.33%, the Dow Jones rose 0.23%, and the S&P 500 rose 0.3%. These increases are all small, making people feel that there's not much movement in the market. But if you pay attention to the trading volume, you'll find that the volume didn't increase synchronously with the index rise, indicating insufficient upward momentum, which may imply that funds are waiting and seeing or gradually withdrawing at the same time. Observing the breadth of sectors, you'll find that the gains are mainly concentrated in leading technology stocks, while small and medium cap stocks didn't follow the upward trend. This differentiation means that the market is not stable. Once large blue chip stocks pull back, the index may quickly turn downward. Therefore, if you only focus on the superficial figures of the index, it's easy to miss potential risks and opportunities. Today, I want to take you to comprehensively analyze the market situation from multiple angles, helping you operate steadily amid fluctuations, not only seizing opportunities, but also effectively avoiding risks. First, let's talk about trading strategies and position management, which are the most basic and important steps in investment. Controlling positions is the first step in controlling risks, especially when you're dealing with leveraged products or high volatility sectors. Without position control, risks will be infinitely amplified, easily leading to the loss of principal. Take the triple leveraged ETF in the semiconductor industry as an example. If the index rises by 1%, your investment may rise by 3%. But if the index falls by 1%, the loss may also be amplified to 3%. This is the double-edged sword of leverage. Therefore, we must learn to reduce positions at high points and increase positions at low points to operate steadily when the index or a certain sector rises near the resistance level. If you don't reduce positions first, it's equivalent to increasing positions on the edge of a cliff. Once the price pulls back, you may suffer heavy losses. The correct approach is to reduce part of the position when the price is close to the high resistance area to protect the safety of the principal. Wait for the price to fall back near the support level, then gradually look for opportunities to replenish the position. This is the core method of buying low and selling high, and it's also the secret of long-term profitability for many top investors. This kind of operation doesn't pursue large gains every day, but seizes a few points of fluctuation every day, accumulating small gains, which will become very considerable returns in the long run. The goal of short-term trading is not to make a lot of money every day, but to steadily obtain small gains every day. Accumulated over time, there will be stable profits in the long run. In addition to position management and the strategy of buying low and selling high, we also need to pay attention to policy news in the market, because policies can often directly affect stock price fluctuations in a short period of time. Recently, government's investment and policy adjustments for key enterprises have attracted great attention from the market. For example, semiconductor, energy, and new energy enterprises are closely related to policies. Once the policy direction changes, the enterprise's strategy, capacity expansion plan, and even profit expectations may be adjusted accordingly. For example, if the government suddenly announces that it will increase investment in the semiconductor industry and intervene in enterprise management, the stock price may rise in the short term because the market expects enterprises to receive more resource support. But at the same time, this may also make enterprises lose part of their independence. And decisions will no longer be completely based on market rules, but be affected by policy orientation. In the short term, this uncertainty often makes market sentiment cautious, and investors will start to wait and see or adjust their positions, leading to increased stock price volatility. Therefore, for investors, policy news may bring both opportunities and risks. We need to analyze rationally instead of following the trend blindly. In addition to policies, the Federal Reserve's personnel changes and monetary policies are also important factors affecting the market. The Federal Reserve's decisions directly affect market liquidity and investor confidence. Recently, there have been news about changes in Federal Reserve officials, which has made investors start to worry about the independence of monetary policies. If the market believes that monetary policies may be subject to political interference, investors may withdraw some funds in advance and turn to safe haven assets such as bonds. This creates the so-called strong bonds and weak stocks pattern, where the stock market may pull back in the short term while bond prices rise. At the same time, the weakening of the U.S. dollar index also indicates that the market has certain doubts about policy stability. Or in this case, investors don't need to panic, but should remain vigilant and pay attention to key economic data, such as employment data, inflation levels, GDP growth, to adjust investment strategies in a timely manner. If you find these operating skills helpful, remember to subscribe. We will continue to share similar strategies to help you profit steadily in the volatile market. In addition to controlling positions and buying low and selling high, investors also need to pay close attention to policy news in the market, because policies often have a direct impact on the stock market in the short term. Recently, the government's investment and policy adjustments for key enterprises have attracted widespread attention from the market. In particular, industries such as technology, semiconductors, and new energy are closely related to national policies. Once the policy direction is adjusted, the enterprise's strategic planning, capacity expansion plans, and even profit expectations may change significantly. For example, if the government announces an increase in investment in the semiconductor industry and may directly participate in enterprise management, the stock price may rise in the short term because the market expects enterprises to receive more resource support. But at the same time, this may also make enterprises lose part of their independence, and decisions will no longer be completely based on market rules, but be affected by policy orientation. In the short term, this uncertainty will make market sentiment cautious, and investors may start to wait and see or adjust their positions, leading to stock price fluctuations or differentiation. Therefore, for investors, policy news may bring both opportunities and risks. Is to analyze rationally instead of following the trend blindly or listening to gossip. The Federal Reserve's personnel changes and monetary policies are also important factors affecting the market. The Federal Reserve's decisions directly affect market liquidity and investor sentiment. If the market believes that monetary policies may be subject to political interference, investors will withdraw some funds in advance and turn to bonds, gold, or other safe haven assets, triggering a short-term pullback in the stock market. Recently, there have been news about changes in Federal Reserve officials, which has made the market worry that policy independence may be affected. And this concern will lead to capital flowing from high-risk assets to low-risk assets, forming the so-called strong bonds and weak stocks pattern. At the same time, the USDOLLAR index may weaken, indicating that the market has doubts about policy stability. Investors don't need to panic, but need to remain vigilant and pay close attention to key economic indicators such as employment data, inflation levels, and GDP growth, and adjust investment strategies in a timely manner. In addition to policies and monetary policies, the wave of IPO unlocks is also a major risk factor that the market needs to pay close attention to. The so-called IPO unlock means that the restricted shares held by early shareholders, company executives, or venture capital funds can be sold and cashed out after the company goes public. When a large number of shares are unlocked centrally, the market may experience oversupply and the stock price may fall. In particular, technology stocks and new economy companies are more likely to be affected. Because these companies are often listed recently and early investors hold a high proportion of shares. Once they sell in a concentrated manner, it will bring obvious pressure to the stock price. For a specific example, suppose that after a technology company is listed for 2 years, tens of millions of restricted shares are unlocked. Early shareholders and funds may choose to cash out. At this time, the supply of stocks in the market increases significantly. The buying order can't keep up. It's easy to cause the stock price to fall back. In the past few years, we can see that every time there is a large-scale unlock, the related sectors often enter a volatile period in advance. And even obvious sell-offs occur. Therefore, investors must be prepared in advance when operating. First, we should know in advance which companies are about to unlock and the number of shares. This information can usually be obtained in the company's prospectus, announcements, or financial information platforms. And we should consider adjusting positions for stocks that are about to be unlocked. Or if the position is too heavy, we can reduce the position appropriately to reduce risks. We can consider allocating defensive sectors, such as consumer healthcare and public utilities. These sectors are relatively resistant to falls and are more stable when market uncertainty increases. In addition, the wave of unlocks will also bring fluctuations in market sentiment. Investors see news of large-scale sell-offs, they may follow suit and sell, forming short-term panic, which is also an important factor leading to increased stock price volatility. Therefore, the wave of unlocks is not only an actual supply and demand problem, but also amplifies the psychological effect of the market. If you know how to predict in advance and seize the right time to enter the market or avoid risks, you can profit steadily amid market fluctuations instead of being passively hit. Next, let's look at the technical situation of SPY, which is the ETF of the S&P 500, representing the trend of the entire market. From the daily chart, SPY's current price is running above the 10-day moving average and the 20-day moving average, which indicates that the short-term trend is still bullish and there is no obvious trend reversal in the overall market. However, if you look closely at the trading volume, you'll find that the volume hasn't increased synchronously with the index rise, which indicates that the market's upward momentum is weakening and the willingness of funds to enter the market is not strong. In terms of technical indicators, the RSI, Relative Strength Index, has entered the range of $65 to $70, which means that SPY is slightly overheated in the short term. The bullish power still exists, but the room for further substantial rise is limited. At this time, if you blindly chase the high and buy, you are likely to be trapped when the price falls back, especially for short-term traders who must pay attention to the support level. Currently, SPY's support level is around 632 to 635, which is close to the 20-day moving average. If the price rebounds with support in this range, it indicates that the short-term pullback is over and there is still a chance to participate in the rise. Support level is broken, then we need to prepare for a larger pullback. Short-term operators can reduce their positions appropriately or choose to wait and see and enter the market after the pullback ends. Let's look at QQQ, which is the ETF of the NASDAQ 100, representing the trend of technology stocks and growth stocks. QQQ is performing more extremely than SPY. It is the strongest among the strong. But once it falls, it is also the weakest among the weak. Currently, QQQ's price is above the bullish moving average. And the short-term trend is still bullish, but the rise is too fast and the volume can't increase synchronously, which is a typical signal of surge and fallback. In simple terms, the stock price rises rapidly, but the buying power is insufficient, and a pullback may occur at any time. In this case, short-term traders should pay attention to the support level, which is currently around 560. If the price holds the support level, it indicates that the short-term pullback may end, and you can look for opportunities to enter at a low level. If it can't break through or the support is lost, then QQQ may enter a volatile or even falling stage. This time, it's better to control the position first and consider deploying after the price stabilizes. At the same time, we also need to pay attention to the breadth of sectors and the follow-up rise of small and medium cap stocks. A recent rise is mainly supported by large blue-chip technology stocks, and small and medium cap stocks are not willing to follow the rise, which indicates that the overall upward foundation of the market is not solid. Once the leading company's rising momentum stalls, the index may quickly turn downward, and short-term investors should be extra careful. Here's a small tip. When the market rises but the sector breadth is insufficient, you can appropriately pay attention to defensive sectors, such as consumer, healthcare, and public utilities. These sectors are more resistant to falls in a volatile market and can stabilize your portfolio returns. Technical analysis is not only about looking at moving averages and support levels, but also combining trading volume, RSI, and market structure for comprehensive judgment. For example, when the index rises, but the trading volume shrinks, and the RSI is overheated, it means that the bullish power may start to decline, and a probability of a short-term pullback increases. On the contrary, if the trading volume increases during the pullback and the price holds the key support level, IT indicates that the market's bulls are still accumulating strength, and the probability of a rebound is high. Therefore, in short-term operations, don't just look at the price itself, but comprehensively judge the momentum, trading volume, support levels, and technical indicators. Only in this way can the success rate of operations be improved. Investment psychology is also crucial. In a volatile market, maintaining calm and rationality is the key to long-term profitability. Do not blindly chase high prices, nor panic sell due to short-term. Learn to wait for opportunities rather than rush into operations. This is the way to achieve steady profits in a volatile market. At the same time, be mentally prepared to accept the fact that the market may fluctuate or even fall in the short term. And do not doubt your strategy because of one or two losses for short-term stable operations. Accumulate long-term returns through small fluctuations. For medium to long-term investments, focus on companies with stable fundamentals to achieve sustained profits amid market volatility. In addition to technical analysis, investors should also pay attention to sector rotation. Sector rotation refers to the flow of funds between different industries or sectors. Sometimes technology stocks perform strongly, while consumer, medical, or energy sectors may be relatively weak. Sometimes defensive sectors rise, while growth stocks or high volatility sectors adjust. Understanding sector rotation is very important because even if the broader market index rises overall, the sector where your holdings are located may not rise in sync, which will affect your portfolio returns. For example, recently technology stocks have risen strongly, but small and mid-cap growth stocks have seen limited gains. This indicates that market funds are concentrated in leading blue-chip stocks, and the foundation for the overall rise is not solid. If you blindly chase small and mid-cap stocks, you may find that these stocks fail to rise or even pull back in the short term. At this time, understanding the laws of sector rotation can help you adjust your positions and stock selections more reasonably. In addition, investment psychology is also a very critical aspect. When the stock market fluctuates, people are prone to greed or panic, seeing stocks rise rapidly. Many people are easily impulsive to buy without considering support levels and risks, which may result in being trapped in a short time. Similarly, when the market falls in the short term, some people will panic sell or even cutting their positions, which often causes them to miss subsequent rebound opportunities. Therefore, in the investment process, the most important thing is to remain calm and strictly implement your own operation plan. Calm investors will wait patiently when the price is close to the support level and reduce positions in a timely manner when the price hits the resistance level rather than blindly following the trend or chasing highs. In the long run, steady operations can often bring more stable returns than short-term aggressive operations. Next, let's talk about risk summary. Potential risks in the market mainly come from several aspects: policy changes, uncertainty in monetary policies, IPO lockup, aiding of market technicals, and imbalanced sector rotation. The policy risks, government investment and policy adjustments may affect corporate strategies, especially in industries such as technology, semiconductors, and new energy. Investors need to pay attention to policy trends in advance and arrange positions reasonably. Monetary policy risks, changes in Federal Reserve officials, and interest rate policy adjustments may affect capital flows. Investors should pay attention to indicators such as interest rate changes, bond yields, and the U.S. dollar index. IPO lockup expirations. Concentrated lockup expirations may lead to oversupply in the market, putting pressure on stock prices and easily triggering market panic. Technical risks. Short-term overheating of indices or individual stocks, unchanged trading volume, and excessively high RSI are all signals of possible pullback or sector rotation risks. When funds are concentrated in a few sectors, if the core sectors pull back, the entire market is prone to a follow-up decline effect. Understanding these risks helps investors remain vigilant in operations and reduce potential losses. In terms of operation suggestions, we can summarize several principles. First, strictly control positions. High volatility sectors or leveraged products do not hold excessive positions to avoid large short-term losses. Second, abide by the principles of support and resistance levels. Reduce positions when the price is close to high resistance levels, and appropriately deploy when the price is close to support levels. Third, pay attention to sector rotation and allocate portfolios reasonably. Combine higher risk sectors with defensive sectors to reduce overall volatility. Fourth, combine technical indicators with operations. Indicators such as trading volume, RSI, and moving averages can help judge short-term trends and the possibility of rebounds. Fifth, maintain a rational mindset. Analyze calmly. Do not blindly follow the trend. Do not panic sell, and long-term stability is the key. When it comes to daily operation examples, we can explain them in combination with actual market conditions. For example, if the Nasdaq index rises slightly today, with large-cap blue-chip stocks leading the gains and small and mid-cap stocks not following significantly, short-term operators can first observe the trend of leading technology stocks to confirm whether there are signs of a pullback. If leading technology stocks start to surge and then fall back with insufficient trading volume, you can appropriately reduce positions or wait and see rather than blindly chasing highs. Conversely, if the price falls back to the support level and a rebound with increased volume occurs, this is a good opportunity to enter the market. You can gradually build positions after the pullback ends, controlling risks within a reasonable range. Take a specific operation. Suppose QQQ is currently around 565, with the previous high at 580. If the price holds the support around 565 and the trading volume increases significantly, it indicates that bullish forces are returning. You can consider buying a small position and gradually reduce positions when the price reaches around 580 to achieve buying low and selling high. Although each profit from this operation may only be 2% to 5%, the long-term accumulation effect is very obvious. Let's talk about historical trend comparison. We can review market fluctuations in the past few years and find a pattern. Or before large-scale IPO, lockup expirations, or policy adjustments, the index usually enters a short-term shock period. Sector rotation is frequent, and the volatility of small and mid-cap stocks is often greater than that of large blue chips. For example, the technology sector in 2019 and 2021 was affected by both lockup expirations and policy adjustments. The overall index did not rise much, but there was obvious sector differentiation. At that time, many short-term traders who only focused on index fluctuations were prone to losses in small and mid-cap stocks. Those who understood the laws of sector rotation and strictly controlled positions were able to achieve steady profits amid volatility. Therefore, historical trends are a good reference, allowing us to judge the current market environment more rationally rather than operating based on feelings. In addition, risk management skills must be mastered. First, set stop loss and take profit points. In short-term trading, it is best to set stop loss points in advance, or reduce positions or exit immediately when the support level is broken to avoid expanding losses. Or second, build and reduce positions in batches. Do not buy or sell all at once. You can operate in several times, which can smooth costs and reduce risks. Diversify the portfolio. Do not concentrate all funds in one sector or individual stock. You can reasonably allocate funds among technology stocks, consumer stocks, medical stocks, and energy stocks to reduce overall risks. Fourth, pay attention to capital flows, observing trading volume, main buying and selling orders, and capital inflows in sectors can help judge whether the trend will continue or a pullback will start. Or fifth, maintain information sensitivity. Pay attention to policies, economic data, and corporate announcements in a timely manner. especially news related to your holdings, and prepare for risks in advance. The psychological aspect is also important in the investment process. People are easily affected by short-term fluctuations and make emotional operations. Seeing stocks soar, many people will impulsively buy without considering technical indicators and risks. For seeing short-term declines, many people will panic sell and miss subsequent rebound opportunities. For maintaining calm and strictly operating according to the plan is the key to long-term profitability. Before operating, you can formulate a clear strategy: entry price, stop-loss position, target return, and position allocation. In the implementation process, adhere to the plan and do not easily change the strategy due to short-term market fluctuations. So as to achieve steady profits, in addition to psychological management, we can also improve the success rate of operations through small skills. For example, use moving averages to judge trends. If the short-term moving average is above the long-term moving average, it indicates that the bullish trend is dominant, and you can consider following the trend. Another example is combining the RSI indicator to judge overbought or oversold conditions, helping to determine the timing of pullbacks or rebounds. In addition, observing capital inflows in sectors can help identify market hotspots and trends, assisting in stock selection and position adjustment. Through these skills, even novice investors can participate in the market more scientifically and rationally, avoiding blind following and emotional operations. Overall, the current market is seemingly stable, but internal risks are still accumulating. Policy changes, uncertainty in monetary policies, IPO, lockup expirations, overheating technicals, and uneven sector rotation may all trigger market fluctuations in the short term. In this environment, short-term stable operations to accumulate returns through small fluctuations, and medium to long-term focus on companies with stable fundamentals to achieve sustained profits amid market volatility are the most stable strategies. Weekly market review is a very important link. Reviewing is not just about looking at index rises and falls, but more importantly, analyzing the capital flows, sector performance, and changes in hotspots behind the market. For example, in the past week, the Nasdaq index rose by 0.8%, but most of the gains came from several tech giants such as Apple, Microsoft, and Nvidia. Or if you only look at the index, you may think that the overall market rise is healthy. But the actual situation is that small and mid-cap technology stocks and growth stocks are mostly fluctuating with insufficient willingness to follow. This reminds us that market rises are often driven by the leading stocks, while the laggards fail to keep up. Or once the leading stocks pull back, the index may also turn downward quickly. When reviewing, it is also necessary to combine trading volume and technical indicators to see the strength of the market. For example, when the index rises but trading volume shrinks, it indicates insufficient upward momentum and bulls may start to weaken, while a pullback with increased volume may be a signal of increased selling pressure. Through weekly reviews, you can better understand the market structure, or judge which sectors and individual stocks are worth paying attention to and which may have risks, so as to adjust positions and operations more scientifically. Analysis of sector hotspots is also an important part of the review. Recently, the technology, semiconductor, and new energy sectors have performed strongly. But defensive sectors such as consumer, medical, and utilities have seen relatively stable gains. Observing capital flows in sectors, you will find that funds usually first flow into high-growth sectors, then into defensive sectors, or quickly shift to safe haven sectors when the market is uncertain. Take a practical example. After the semiconductor sector rises for several consecutive weeks, IF trading volume starts to shrink and funds begin to flow into the consumer and medical sectors. This is a signal of sector rotation, indicating that higher risk sectors may face pullback pressure. Understanding the laws of sector rotation can help you find opportunities in a volatile market while avoiding potential risks. For example, when technology stocks adjust, you can lay out defensive sectors in advance to make the overall portfolio more stable. Analysis of capital flows is also indispensable. There is a large amount of capital flowing between different sectors, ETFs and bonds in the market. Observing capital flows can judge market hotspots and trends. If a large amount of capital flows into blue-chip ETFs of the S&P 500, while capital flows out of technology growth stocks, IT, indicates that institutional investors may be adjusting their positions and short-term market risks are high. On the other hand, capital inflows into defensive sectors or safe haven assets, such as gold and bonds, indicate that the market is beginning to show risk aversion. By paying attention to capital flows, investors can judge short-term market trends in advance and adjust positions in a timely manner, rather than passively following market fluctuations. Next, let's look at short-term, medium-term, and long-term operation strategies. Short-term operations focus on technical aspects, support levels, resistance levels, and capital flows. The goal of short-term operations is not to make huge profits, but to seize a few points of fluctuation every day and accumulate small gains. Medium-term operations pay attention to sector rotation and capital inflow trends. Select sectors with upward trends for band operations and combine technical indicators to judge buying and selling timing. Long-term investment focus on corporate fundamentals, industry prospects, and valuation levels. Even if the market fluctuates in the short term, companies with stable fundamentals can still grow in the long term, bringing stable returns to investors. For example, if you are optimistic about the long-term development of the semiconductor industry, you can hold stocks of leading enterprises in the industry. Even if there are large short-term fluctuations, you should not sell them easily and wait for the returns brought by long-term growth. In addition, it is essential to combine risk management strategies in operations. First, set stop loss and take profit points to avoid expanding losses. Second, build and reduce positions in batches to reduce the risk of cost fluctuations. Third, diversify the portfolio and reasonably allocate funds among sectors such as technology, consumption, medical care, and energy to reduce overall risks. Fourth, pay close attention to market information, policies, economic data, and corporate announcements are all important references. By strictly implementing these strategies, you can make steady profits in a volatile market and avoid losses caused by emotional operations. Investment psychology is also crucial. When the stock market fluctuates, emotional management directly affects the operation results. Short-term rises can easily make people greedy, and short-term declines can easily cause panic. These emotions will make you deviate from the strategy. Stay calm and strictly implement the plan. Wait patiently when the price is close to the support level, and reduce positions in time when the price is close to the resistance level. In the long run, such steady operations are more likely to achieve sustained returns. Finally, let's make an overall summary and review. Although the current market index is stable on the surface, the internal structure is obviously differentiated, and potential risks are still accumulating. Policy adjustments. Uncertainty in monetary policy, the wave of IPO overheating technical aspects, and uneven rotation of sectors may all trigger market fluctuations in the short term. For short-term operations, adopt steady strategies and accumulate long-term returns through small fluctuations. For medium-term, pay attention to sector rotation and seize band opportunities. For long-term, focus on enterprises with stable fundamentals to achieve long-term and steady growth. In general, although the current market seems stable, there are undercurrents, policy adjustments, uncertainty in monetary policy, the wave of IPO and overheating technical aspects all remind us that risks in the stock market always exist. What investors need to do is not to blindly chase ups and downs, but to rationally analyze the market structure, pay attention to sector rotation and capital flow, and strictly implement position management and stop-loss strategies. For short-term, operate steadily and accumulate small fluctuations into long-term gains. For medium-term, focus on trends and sector rotation to grasp band opportunities. For long-term, stick to enterprises with stable fundamentals to achieve steady growth of wealth. In the investment process, calmness and rationality are always the most precious qualities. Only by combining risk management, psychological control, and strategy implementation can we remain invincible in the volatile market. If you find today's content helpful, welcome to subscribe to the channel so that you can get the latest market analysis and operation strategies at the first time, making every investment decision more calm and steady. Remember, there are always opportunities in the market, and there are always risks. Keep learning and thinking, and your investment path will become more and more stable.